We'll now call the retirement board meeting to order at 2 p.m. Board communications, any board communications to share?
Nope.
Nope.
Yeah. And I was just mentioning before the meeting that we have some applicants, so hopefully we'll be at full capacity at the next meeting. Dee, do you want to give us an update on the pension trust fund quarterly ending?
Yes, so I'm hoping that you all were able to receive the second revision. I apologize for the multiple versions. There's a lot of moving parts this time of the year with working in 2 fiscal years. So was everyone able to get that version?
I was.
Yes.
Okay.
Yep.
So some of the main points are there was a decrease in the revenues, mainly attributed to the change in the fair market value, which I'm sure will be touched on later, which was a pretty significant drop. And the expenditures have increased due to the number of pension payments. There was an increase in the number of retirees. And overall, the total fund assets have decreased by approximately $24 million from last June. Does anyone have any questions?
You're not allowed to give bad news. Come on.
I looked at last June, it went up about 24 million. So
Well, hopefully we'll start going up. Next item, retiree COLA. This is just notice that the town council did authorize a 2.5% cost increase to retirees who have been retired at least 5 years. So just making the board aware of that.
Just a quick question on that. Is that only for the town employees? Does that include the fire department as well? Or
We
they're
only
separate?
speak, they're separate, just the town. So,
That's what
so
I
not
thought.
even-
I just want to
Not
clarify.
even the Board of Ed either. They're separate too. So
Thank you.
And John, when was that effective? July 1st or?
Yes, with the July payment. This is Arnisha. Hi, everyone.
yep, July 22. Yep, July 1st, 22. Other questions? Okay, if not, we'll move on to the authorization of payments. We have 2, Peter Giorgetti and unfortunately Cindy Landry, our recently retired finance director who will be missed. She brought us better news, Dee.
Oh, ouch.
So, do we have a motion to approve those 2?
So move. This is Mark.
I'll second it as Jason.
I have a first and a second. Any discussion? If not, those in favor say aye.
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 Those opposed, same sign. Motion carries. And we'll go into the SCI investment update.
Hey, John, this is Ken. Can Patrick and I switch this meeting? I think it'll be easier when we get into the asset allocation recommendations for him to.
Oh, sure,
segue.
that's fine. Yeah,
Yeah.
that's fine.
Okay, excellent. Thank you. I'm gonna share my screen if that's possible. Let's see.
You should be able to.
Yeah, let's see. Can everybody see plan investment review?
Yes.
Yes.
Yeah,
Yes.
perfect.
Yes.
Okay. Excellent. So we'll talk kind of following up to what Dee had alluded to. Obviously, an extremely difficult first half of the year. Really, with the second quarter being that much more difficult than the first quarter, but both were historically tough. And we'll talk. I'll talk a little bit about that. Patrick will get more into exactly what happened with the fund. Kind of a precursor. I think the good news is that since the end of the second quarter, we've seen the markets rebound significantly. So hopefully, cross our fingers that this holds. Third quarter should be that much better. So as I mentioned, second quarter, really first half of the year, tough markets. And really what's historical about this is there was no place to hide. Normally when the equity markets get crunched, you can, go into the fixed income markets and have a little protection there. But when you have an inflationary environment, which the Fed was very aggressive to try to fight, and they raise interest rates in order to try to fight that, not only do the equity markets not like that, but the fixed income markets don't react well either. And so we had a scenario in which virtually everything that you can invest in went down over the course of that time. And so you've got a situation in which interest rates are rising based on the fact that try to fight a rising inflation environment, but you also have a scenario where you've got stagnant or growth that actually is turning negative. And we call that a stagflation environment, and the markets really don't like that. And so the last time we really saw that take hold was the late 70s, early 80s, when you had, interest rates that were, kind of getting close to 20% and negative growth environment. And so the question is are we in that environment, in this go around? And what this page that you're looking at kind of compares, the two environments. We had a similarity, that's kind of that middle gray shaded box, where you had high inflation in both scenarios, almost 9% in 81, over 9% in June of this year. Weak growth backdrops, kind of fighting, a losing battle on the growth side. Supply disruptions. Anybody that was old enough can remember the oil embargoes that we had back in the 70s, and this time around we've got, the pandemic and Russian sanctions. You had actually very aggressive and fighting from the Fed side a little bit late on back in the 70s, but once Volcker really took hold, he fought it hard, and obviously Mr. Powell has done the same this go around. And the consumer really, was losing the battle with inflation, and their sentiment was falling. So all that portends to not a good environment, similarities back in the 70s and 80s. But what's different is back then we had a very high unemployment rate. We had almost 9%, 8.5% back in 81, and now we've got historically low unemployment. So that's good. Again, kind of a slow Fed response at the early stages in the 70s. While I think some would have hoped that the Fed would have acted even quicker than they did this go around, they did come to play fairly early on. So, much quicker response. Back then we had a federal funds rate that was hovering around 10% to start, eventually, worked its way up. But, this go around, we were at a relatively low level, actually, 0%, so very low base. And the persistent 70s inflation led to, rising wages and consumer prices. We've got that going on now, but the question is, how persistent will the inflation be? Have we been quick enough to fight it? And back then, the Fed did not intervene in the bond markets. This time around, and really over the last 10 years, they've had a series of buying, where they can, try to fight the inflationary, front from that level. So we think that there's significant differences in the two environments that would not necessarily automatically lead to a stagflation environment, and really more to follow on that as we see, whether we are in a recession now, whether we're leading to a recession, how mild or severe that recession will be. But we think there's significant enough differences not to be fearful that this one will lead to the same kind of environment that we had back then. So the question is, how bad were the markets? And Dee kind of hit this one on the nose, where basically we went from what was more of a correction oriented type market to a bear oriented type market, where we've had lower returns, basically 20% or lower by the end of the second quarter for virtually all the equity asset classes that we've been in. The silver lining, as I mentioned, that we may have hit a low point in the middle of June, and since then the S&P 500 or equity markets have rebounded up to 15% gained since the middle of June. More intensely technology-oriented type stocks have actually gone up by more than close to 20%. So, anywhere between a 10 and 20% gain since the middle of June, has happened. And again, we've seen a report this week on inflation not being necessarily as severe as what we had thought it was, or maybe that's coming back. So the question is, can that hold, and will we continue to see a rebound through the end of this quarter? Historically, August, September have not been great months for equities, kind of leading to a rebound historically in November, December timeframe. So we'll see whether that will be something to watch as we go forward. I think kind of when we look at the economic scorecard here, the thing to really watch, I think, will be corporate earnings. We talked a little bit about this last time. How the consumer is spending ultimately winds up, in the ability for corporations to say whether their earnings, are what they need it to be in order to sustain equity prices. So watch, where not only what corporate earnings are stating, for that particular quarter, but what's the guidance that they're giving? Are they saying that, their business is expected to go up or down based on what they see the consumer doing? How much can they pass on the inflationary spiral back to the consumers? What does that do to inflation for the consumer? So I think corporate earnings as we go forward will tell us a lot. And obviously inflation, growth, housing, in terms of what we're looking at from a housing perspective. I think all those are important factors, as we go forward. And I think one of the other silver linings that we talk about is the kind of the length of expansions and corrections. Historically, we've had a much longer rise in the length of expansions than we do from the contractions or the corrections that we have in the market. So it's sort of like, doing that long run, and you've got that unbelievably difficult hill to climb. But once you peak that climb, then all of a sudden that downhill is a lot longer. That's sort of in reverse what the expansions and contractions are on the economic side. Very long-term expansionary environments with that quick and very sudden downturn. I think hopefully that's what we've seen in this go around. Why stagflation environment is necessarily important is if we look at this chart on the left, on page 8, you can see that 1981 comparison where that's one of those times where the actual contraction was longer than the expansion. So the difficulty of a stagflation environment can make those expansions and contractions that much more difficult. And then finally, what the Fed is doing to interest rates does have an impact on the yield curve. That's the yield that you're getting on rates across the board. So normally in a regular yield curve, you're going to have lower yields for shorter maturities, higher yields for longer maturities. When you get an inflationary time period, sometimes that can invert, where you can actually get a higher yield on a shorter maturity, lower yields on the longer maturities. That typically leads to a recessionary environment. I think that's where the market is telling us that we're either in right now or we're getting to be. Certainly at this point in time, the lower yields are higher than certainly the 2-year yield is higher than the 10-year yield. In this environment right now, the question is, will that stay? Can we get that soft landing? So, we've had a very difficult first half of the year. I think there are some silver linings here. From a contrarian standpoint, sometimes, when things look the worst, that's exactly the time to be in the market, to get back in the market. We don't know whether this is a bear market rally or whether this is something that is sustainable. But I think, again, from that long-term perspective, it's better to be in the market, and let the market, kind of take care of its own. Those are when the opportunities really take place. Let me just quickly finish up by talking a little bit about the funds. Patrick will talk a lot more about them, but From the performance standpoint, again, very difficult. The 3-month column, is the second quarter. You can see a lot of negative numbers there. Year to date, same thing. Again, as we look forward into the next quarter, assuming that, the rest of August, September don't completely turn on us, those numbers should be positive, should be, much more attractive. Most importantly, from a governance standpoint, the last column, the ranking tells us whether these funds are doing their job. Do they pass the investment criteria in the investment policy statement? Everything in green tells us that they are. We can see historically on page 18, everything has been in green, for the last few years. And then finally, if we look at the average score for all of the funds, we have a score of a 10, which is similar to what we've had over the last couple of quarters. The lower the number, the better. This suggests that on average, these funds are performing in the top decile when you compare to alternatives that you might be invested in otherwise. So longer term, these funds are performing well. Obviously, on an absolute basis, struggles in the first half of this year, particularly the second quarter, but some silver linings as we go forward. All right, said a lot. Questions, comments? Okay.
Any questions?
All right. All right, I'll be here. Any questions come up, certainly ask, and and I look forward to Patrick's comments in terms of, where they see things and recommendations going forward. So I'll stop sharing my screen now.
Okay,
And turn it back to you, John.
great. Now we're moving back to Pat to give your update.
Okay, great. Thanks, John. Ken, thank you for that. So that's going to shorten my presentation a bit because a lot of what Ken talked about, I would also speak to, but I do have a couple of slides I want to go through briefly. Then I'll touch on the performance in a little bit more detail. And John Wade is on the call with us today. He's the director of our advice team. So him, Ken, and myself have been working on an asset allocation study, and we do have some recommendations, which he will speak to in just a little bit. Okay, so let's skip these equity market reviews. So this is something different here, and it's more of a technical analysis, but I thought it was interesting. So if you look back through history and you look at stocks in the S&P 500 trading below their 200-day moving average, typically what we found is once 90% of the S&P 500 stocks are trading below that 200 days, the markets usually have a pretty good rebound. So we saw this about 3 weeks ago. It actually hit that technical factor. And what we're looking here on the, oops, a second here. So we're looking here on the right-hand side is what, after the breach of the 90% threshold for those stocks in the S&P 500, what did the markets do 6 months after that? And what did they do 1 year after that? So looking at the 6 months, you can see there were a couple periods here in the early 70s, which can allude to Ken's presentation as well. Some of the problems we had in the 70s and the 80s. 2008 obviously was a credit crisis. So there were the only 3 periods where we had negative returns. But if you look at the average over these periods, the average gain after that was 6.5%. Okay. So let's take that a step further. Let's look out 12 months and the picture gets even better. So if you look at 73, that was the only negative. 2008 was relatively flat. But the average return after this technical factor hit was 19.1%. So again, this could be some light at the end of the tunnel. Another way to look at it, we have seen markets respond since mid-June, as Ken mentioned, and have been performing very well even up to today. And I'll give you an updated number in just a bit as of yesterday's close. So going along with this, I like these charts because it talks about market timing. So the first chart is page 10, and I apologize, my dog's barking in the background. It's exposure. If you leave the market in a bull market, if you leave too early, what happens? So the top line represents the months, minus 12 months to positive 12 months. The opportunity cost is the amount you would lose by leaving the market early. And you could see the market loss after the market peaks on the right-hand side. So I'll give you some numbers here. So if you left 12 months before the market peak, you would have lost on average 24% by leaving the market too early before a market peak. Okay. And also looking back, selling just 1 month after the market, peak would have resulted in an average realized loss of 7.4%. So again, it's hard to time the markets. It's hard to mistime a market to a market peak, and then vice versa. Potential cost of mistiming a market trough. So what happens when the market bottoms out? Let's say the market bottomed out in mid-June, right? What's the opportunity loss if you don't get back into the markets in time? So what we're looking at here is you can see that historically, investors who miss even 1 month is a 15% opportunity loss. So if you mistime the bottom of the market, you got in 1 month late, you could have missed out on 15% returns just from that small period of time. And it really gets even worse than that. So if you look going to, if you were 12 months late, you would have lost over about 30% on the upside. So all in all, it's a matter of why we really should have a well-diversified strategy, make tweaks to the portfolio at times, but really focus in on what is important to the plan, the health of the plan, and how do we strategize and get that original asset allocation in place so we can ride these markets out and not try to time them. That's the moral of the story here as a whole. On page 12, I'm just going to touch on fixed income briefly here because Ken already dove into this, but a couple of things. One, obviously the Fed is raising rates. We've seen that. And, it's really impacting the shorter end of the yield curve, right? So we went from a 0 Fed funds rate. Now we're moving up to over 2% Fed funds rate, probably after the next meeting. So that's been pretty significant. But the thing I want to discuss here is duration and what that means. So Ken referenced maturities. So for instance, your core fixed income fund has a duration of 6.5%. Okay. So if interest rates go up by 1%, there's an inverse relationship. Rates go up, fixed income prices go down. That's what we've seen in the markets. So if interest rates go up by 1%, you have a duration of 6.5. That means your portfolio, that strategy will on average go down about 6.5%. So direct correlation there. But shorter duration, where you have 1 durations and 1.5s, even though those are going up very fast because of the Fed funds rate and their activity, you move into rates quicker in those because you have a shorter duration, shorter maturities. So you're leaping into the higher rates quicker, and your returns are less negative than higher duration securities. So I think that's important to note. So again, even though rates have come up on the short end, shorter duration vehicles, shorter maturity vehicles have outperformed the longer end of the yield curve. And really, that was kind of more of a segue into John's presentation in just a little bit. Does that make sense to everybody? The duration of 6.5, interest rates go up by 1%, you lose 6.5%. If you have a duration of 1 and interest rates go up by 1%, you only lose 1%. If you have a 20-year bond or 20-year durations goes up by 1%, you lose 20%. So that's why the short end of the yield curve has been outperforming the middle part of the yield curve and the longer part of the yield curve.
One of the things, Patrick, I'll add is that the reverse happens as well. So if interest rates go down, then that duration can lead to a positive performance for fixed income, which is the scenario we've been in up until really the last year or so. One of the reasons why fixed income has performed well, but it's a risk that you just don't normally want to associate on the fixed income side. If you're going to take, risk, try to do it on the equity side, keep fixed income relatively stable. So
that's correct. Thanks, Ken. Okay, so page 16, unfortunately, we're not showing this through July because it was much better, but you can see your year-to-date return here on a gross basis was negative 16.58, so that was down significantly. And while we slightly underperformed the broader index, we held in pretty good considering what's been happening with all the volatility. On the equity side, again, we're mainly indexed here. So you have large cap index, you're always going to be following the index. You're going to be pretty much right in line with it. Also, the Vanguard S&P small cap index, same thing. But overall, US equities are down over 20%. So that's that bear market territory, which Ken was alluding to earlier. And on the international side, year to date, international actually performed a little bit better than US equities as a whole. That was down negative 18.53%. So about almost 2% difference there, a little over 2% better performance from international versus US equity. And here's where you can see that duration story, right? So core fixed income has a longer duration. Rates went up so much, okay? They went up more than 1%. They went up 2.5%. You could see that negative 11.16 return on the year-to-date basis. High yield bonds, while we like that asset class, it's more of equity-like asset class with a little bit lower risk, performed better than equities, but also had very strong negative returns. And then the real estate fund, again, kind of in line with equities there, so down about 19.6%. So all in all, it goes really kind of summarizes what Ken was speaking to earlier. We had an environment where rates are rising and equities are selling off at the same time. This is just another look. We're looking at calendar years here. So as you can see, 2021, we had a very strong calendar year, but we gave all that back and then some, unfortunately, year to date so far, but the picture has changed. So why don't I just give you the most recent value while we're here at this point. So as of yesterday, the portfolio was back up to 137,724,687. So that's 137,724,687. So a rather significant move in less than a month. We've gotten a lot of the value back. Obviously, still have a long ways to go. And we still believe there will be volatility because it's a matter of, do we have a soft landing with all these Fed rate hikes, or do we run into a recession where we could see further downward pressure on equities? Any questions about market timing or returns or? Okay, sorry. I'm sorry, go ahead.
No, go ahead.
Okay. All right, so we'll end on the good news. We're back up to 137,724, and then I'll hand it over to John to go through the asset allocation study, which we discussed in depth over the last several months with Ken and myself.
Thank you, Pat, and good afternoon, everyone. We're on page 20 of our slide deck, but page 29 of your board packet for the meeting. And I'm going to have some discussion here on, as Ken and Pat had noted, on the overall asset allocation. Your current allocation on the left-hand column with 37% in US large cap index, another 7% in small cap. So all of the US equity is indexed. The international equity also indexed there. Those are the third and fourth lines, coming up with a total equity exposure of 57%. Below that, we've got your fixed income, 1% allocation to high yield, 39% in core fixed income, so 40% in fixed income, and then the real estate below that at 3%. So I'm showing a portfolio A here and a portfolio B. Portfolio B is larger moves along the same lines as portfolio A. Our recommendation for today will be portfolio A, so I'll spend most of my time on that. What we'd like to recommend to the board is some changes both in the fixed income space as well as in the equity space. So you've got significant allocations in the US equity area in those first two lines there, 44%. We'd like to pare some of that back, add a little bit to the world equity. Right now in that current portfolio, you've got 77% of the equity portion invested in the US and 23% outside of the US. And if we look at global GDPs, the US portion is quite a bit lower than that 77%. So we'd like to start moving, getting a better balance between the US and the non-US. So adding a little bit to the world equity ex-US index there, bringing it from 11 up to 15. And then also introduce a different equity strategy that just above the orange line, the US equity factor strategy. And when we were discussing this with Ken, we had initially been looking at the 15%, but he recommended maybe we just it's a newer fund. It's been in the US for a number of years now, but maybe it makes sense to dip our toe into this new strategy. This strategy is a midpoint between fully indexed or passive strategies and fully active strategies, where the managers have quite a bit of discretion in the stocks that they pick. This looks at three primary passive strategies, but mixes them together rather than just looking at the overall market capitalization strategy, which is the index strategies above. So it looks at the value stocks, it looks at momentum stocks and stability stocks. And you've heard over the past couple of years about how the Teslas and Googles have run up. Those are the growth stocks, and left behind have been the value stocks, the ones with higher quality ratings and so forth, that have really just been pushed down because the markets have been moving toward those growth stocks, and there has to be a turnaround at some point. And we feel that, you know, in the U.S. equity factor over the first half of the year and a bit longer has really outperformed because of that value tilt. We think that it still makes sense to continue to add a little bit of that value tilt in there, as well as the momentum and the stability. So a small allocation to the U.S. equity factor. Pat, did you have anything else you wanted to add on the factor fund?
No, I think that's perfect, John. And the good thing about the U.S. equity factor base right now, it does have a value tilt to it. That's probably the strongest play we have in there right now, but it can move, right? So if we, eventually we see things change and the opportunity set comes more in line for growth, and we can move that direction without, changing funds. It will all happen within that particular strategy. So it's not just stuck at value, but right now that's the largest overweight is value in that particular strategy.
Thanks, Pat.
Quick question. Sorry, this is Jason. Would that be similar to something along the lines of like with personal finances, like the 2030 fund or a 2040 fund, where it's going to change as time goes on, depending on where you are in the cycle?
So it's not, I'm sorry, go ahead, John.
Go ahead, Pat.
It's, well, that's more like a target date fund for retirement. So as you're getting closer to retirement, it's going to reduce your risk, right? So it's going to reduce your equity exposure as time moves on. This is more, it's more driven by different factors that are hitting the markets, what market cycles we're in. Right now, all the signals are screaming value. So that's why we have an overweight to value in that particular strategy. But again, 6 months from now or 12 months from now, those signals might not be there anymore, and we might start moving more into growth-oriented securities. So right now we're looking at it as more, this small allocation will help you de-risk from some of the indexing that you're in that has very large allocations to these technology stocks, which at one point they grew almost 20, the big 5 technology names grew to over 20% of the S&P 500. So there's a tremendous amount of exposure to just a handful of stocks, where this will help. We're taking some risk off the table from the equity side, but also leaning into a market where rates are going to continue to rise and value traditionally does well in those types of markets. Does that make sense?
Thanks. Yeah, it makes sense.
This is Carol. I have a question. If we change our asset classes and add this total equity exposure, I see the fee impact is +1 BPS. Can you explain how much our fees will increase?
Yeah, so that's a very minor increase. And a lot of that's really happening from the fixed income side, which we didn't get into yet. But what's happening is when you move into asset classes like emerging market debt, they're a little bit more expensive. So there's a minor 1 basis point fee increase as a result of going into some of these asset classes. From a dollar perspective, I'd have to do some math while John is talking to give you that, but it's probably just maybe a couple $1,000. Nothing significant.
Thank you.
And vice
Anything-
versa. In the future, if we decide to make a move away from some of these things into an indexing strategy, we're going to reduce that fee. So it's not just a matter of we're coming out here as high inflation, we're saying we're raising our fees. It's really just a factor of the asset classes that we're going into that are more expensive.
The thing that I like about this particular recommendation, and particularly that portfolio A is John, mentioned, the original thought was to go more heavy and I'm sort of a touch the toe to the, to the water kind of person, and see how it works. But what this does is it gives more diversification, more opportunities to touch into other asset classes, other areas that you're not currently involved with. And we'll talk a little bit more on the fixed income side as well. And to give a little bit of what I would call tactical opportunities to see based on some predetermined factors what's attractive in the marketplace. So is it time to kind of move into that more attractive space, versus not having that opportunity under this current structure, current strategy that we're in. So it's not, it's not taking and having an overexposure to it. It's more gradually, getting into a more diversified opportunity, which is, as you can see a little bit down, kind of lowers that standard deviation or the variability of the return, a little bit. So I think over time that works out, and obviously, a lot of pressure on the SEI managers to be able to, to deliver on that. But I think that's, in a small situation, the opportunity to be a little bit more tactical, I think makes a lot of sense here.
Quick question. This is Jason again. So the equity factor fund, is that more reactive, or you kind of can see things happening in the market and it adjusts and slides that way?
It's not reactive to what's happened in the marketplace. Sometimes we'll get these trades incorrect. Actually, we had the value trade on in this probably about for almost 2 years. So all the indicators were there. The value should outperform in the near future, but it didn't happen right away. So we were a little bit early to the trade, but over the last year and a half, it finally hit, and we saw value come into play. So it's more preemptive than being reactive.
Thank you.
Anything else on the factor issue, or I'll move forward on and address the fixed income changes, if not. In the fixed income space, you can see a number of changes being recommended here as well. Part of it is to add a little bit more weight to that high yield, and to add some exposure to some emerging market debt, which is non-US debt in the emerging markets. And these two items sort of grouped together, they're really return seeking. I think Pat referred to them as equity-like. They're return seeking asset classes, but they are fixed income. So we'd like to include some allocation to these to help diversify the sources of return, which right now are primarily in the equity space, and to help provide some diversification and management of the risk profile. So we're taking, you can also see in the orange line, we're taking 3% out of the total equity allocation. So we're adding that into the emerging market debt. And then we're taking a couple percent out of the core fixed income and adding that to the high yield in order to get a more diversified return and risk balance for the portfolio. And our outlook is positive on these as well. We think they're going to continue to be good diversifiers and return generating assets over time. That core fixed income, Pat had gone through the discussion on interest rate sensitivity or duration. We've got a big piece of the portfolio there now, 39%. So reducing that, adding a little bit to the high yield, and then adding that limited duration fixed income. Pat alluded to discussing some diversification strategies within fixed income, and this is really what we're looking at. So adding this limited duration fixed income, and this has less interest rate sensitivity or duration. So in times of sharply rising rates, what you're going to see is that limited duration is going to outperform the core fixed income. The trick within the fixed income space is really balancing current return or yield versus sensitivity to interest rate changes. So the limited duration has less interest rate sensitivity, so it'll be a little bit steadier return pattern over time with changes in the market. But it's going to, when rates are stabilized, it's going to have a little bit lower return. But it provides us some diversification there in the sort of the ballast of the portfolio. And we think it makes sense to have a little bit of diversification there, not adding a lot, but adding about a third of that higher quality fixed income. It has similar attributes to the core fixed income, but just less interest rate sensitivity. And you can see at the bottom of each of the columns, I've got a number of metrics: expected return, intermediate, and equilibrium. These are based on our expectations for each of the asset classes and how they, in terms of return and risk, and how the asset classes interact with one another. We come up with these expected returns. You can see no changes in expected returns for that intermediate. Equilibrium is statistically the same. That standard deviation is down a little bit, which Ken had noted earlier, meaning we've got a little bit more protection on the downside. And we can see that graphically on the following page. So I've run each of the portfolios through 1,000 economic scenarios over 10 years, and I look at all of those outcomes, those potential return scenarios. In the middle of the bar, I put the median or expected return. The top of the bar is the good scenarios. The bottom of the bar is the poor scenarios. And when I'm looking at these, I'm looking at the size of the bar represents the risk in the portfolio. So a bigger bar means more risk, more variability in the range of outcomes. So when I look at these, I look at the middle of the bar. What's the change in expected return? I look at the overall size of the bar, and I look at the bottom of the bar. The top of the bar are great scenarios. We'd like to see those, but our concern areas, the bottom of the bar and the overall size. So that portfolio A, same return in the middle, expected return 6.3. The bar is a little bit smaller, so it has a little bit less risk, and it also has a little bit more protection on the downside in the very poor scenario. So a little bit of a pickup there. Overall, we think that portfolio A provides a nice additional distribution of spread of different asset classes and diversification, while keeping the same risk return profile for the plan that we've currently had and been comfortable with. We may come back to just further discussions at some point on that portfolio B, which is a bigger move along the same lines. But right now, we think portfolio A probably makes the most sense.
Is this a whole thing based on what's happening right now? This is Carol, by the way. Is this based on what's happening right now in the market? If the market rebounds, would this still be a good way to go with portfolio?
That's a very nice question. Thank you. This is a longer term strategic recommendation. So I'm not looking to time the market, saying that the markets are up or down. This is what I think makes sense for the fund over the long term horizon. Now, with backing off on that a little bit, within each of those strategies on the prior page, the managers are making decisions. Well, the index funds are just following the market. That active U.S. equity factor, we're tilting the factors that we have in there, the value factor, for example, that Pat talked about, depending on market things that are happening in the market. The core fixed income, the limited duration, high yield, emerging market debt, the managers within those funds are making changes based on their outlook for the market and what's happening. But in the index stuff, that's just going to follow what's happening in the market. So I think this is a nice change for the long-term outlook for the plan.
Okay, I guess my puzzlement is in that next slide over, it shows the current one has a higher 29.2% return, and then your suggestion, it goes down.
That 29.2 is a very good scenario. That's not the expectation. The expected return is right in the middle of the bar at 6.3. So we're showing very good returns at the top, very poor returns at the bottom. And yes, we're reducing the overall risk profile. So you're giving up something in those very good scenarios. Yes, you're right. You're getting a little bit more downside protection. On a compounded basis, year over year, what happens is that, yes, you're giving up something in the greatest 1 year return scenarios, but you're getting some protection in the very poor scenarios. And that downside protection, it turns out to be more important typically than the give up that you're having at the very top. And so you'll end up with a better compounded return over time because you've got lower overall risk or volatility.
Thank you. Thank you for explaining that.
Carol, generally, when you add diversification, you kind of mute the extremes. You kind of limit the upside, but more importantly, you limit the downside as well. And I think that's what the goal here, is all about, just to see if we can, pack in the returns into more of that expected return rather than go through the extremes. And I think one of the things that this market has proved is that we can be extreme on the downside, as well. And is there a way of strategically long-term, trying to mute that level of the extreme? You may give up a little bit on the upside, but, controlling that downside is never a bad thing in my opinion.
I guess it's because we've always been so conservative, and my worry is that, are we taking, a chance to be more volatile or something? But I guess from your explanation, it doesn't sound like it would be.
Yeah, I think this is more of a kind of in that conservative approach, rather than trying to take on more risk. We're trying to minimize that risk as best we can.
Because we've always done pretty good,
Yep. Absolutely.
Thank you.
So this is Jason, just another quick question. So why show us the portfolio A and portfolio B? It almost sounds like maybe because it's a fairly new fund. That's why you're recommending A rather than B and only putting in 5% rather than the 15. And I assume that's probably a recommendation from you, Ken?
Yeah, it is. I mean, there's certainly nothing that prevents us from relooking at this a year from now and saying, are you comfortable with the approach? Do we understand it? Do we see how it's reacted to different market segments? And are we comfortable in expanding that recommendation and allocation to the higher levels? But I think this is, instead of just jumping in with the full, change, kind of let's take it in steps. So I think this is a reasonable first step, to the change, and let's reevaluate that in a year from now and see how it looks, and see if if SEI still has this level of recommendation or perhaps something else. But yeah.
Okay, thank you.
John, do you want to touch on 22? So that was just based on the shorter term returns, so over our next 10 years. The next page on page 22 is longer term.
It's more of a 40-year horizon, sort of life of the plan. In the shorter term, we expect fixed income rates to rise, so that's going to be a drag on the fixed income returns. We think in the shorter term, equity returns generally are going to be a bit more muted, but long term, over the life of the plan, we expect higher performance out of the equity as well as the fixed income in real estate spaces. And that's what is represented on this set of we call them capital market assumptions, our assumptions on returns. And so when we look at a much longer 40-year horizon, what we see is higher returns. And here you can see it's a similar story, 7.9% expected return in the current portfolio, 7.8 in that portfolio A, a little bit lower because we have that fixed income We've taken a lower return, lower volatility fixed income strategy in there. But the bar is a little bit smaller, and we've got a little bit more protection on the downside. So it's a similar story as on the prior page, but just looking at longer term view to support your, I believe it's a 7% actuarial rate.
Any questions? So just one more thing I'll point out. So looking at today, the 6-month T-bill yield was higher than the 10-year. So right now, I mean, it takes a while for duration to kick in, right? So 6 months from now, those shorter maturity funds or instruments will have yields comparable to core fixed income, for instance. So you're taking on less interest rate sensitivity by moving down the yield curve and getting a similar yield in the next 6 months to a year. So it makes a lot of sense to shorten duration. Again, no one can time interest rates, but so that's more of a kind of a more of a tactical move that we're making there, where because we all know rates are going to rise from here. It's just a matter of how far. And again, that's why we'll, as Ken mentioned, we'll look at this every 6 months and we'll take a look where we're at with interest rates. Does it make sense to go even further short duration, or maybe move back in the middle of the yield curve, or even further out in the yield curve?
Okay, any more questions? Are people comfortable with the change? Does anybody want to make a motion? Is there that interest?
This is Jason. I'll make a motion. We go with portfolio A.
This is Mark. I'll second that motion.
Okay, we have a motion and a second. Is there any discussion?
Yeah, just Jason here. I'd love to maybe try to circle back in 6 months and kind of take a look at it. I don't know if a year is too long. If we're, I don't know what Ken thinks about that.
So in our
Yeah,
February meeting?
There's certainly nothing, wrong with, looking at it every 3 months or certainly 6 months. My challenge is the markets are so crazy and so volatile that we may not necessarily get, the right picture at that point in time, in terms of evaluating the success or, the change of that. So I think looking at it in 6 months, nothing wrong with that. I think a year maybe down the road gives us a little bit more stability in terms of where the markets are, but that's what.
Okay, yeah.
Year timeframe.
No, I can agree with that. Yeah, a year's fine.
And typically,
obviously, unless you're seeing something, right?
Right. Yeah. If we'll see something, I mean, we're seeing some. We're not going to wait till the next meeting
Right.
if it's that meaningful. But I think also, what I've done with John and all my other plans as well, we do these studies, these advice studies, at least once a year. So that's going to be more common as we move forward, and then we can have those discussions at least during those studies. And obviously, we'll reach out to Ken well in advance of those meetings.
Any other discussion? If not, all in favor say aye.
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 Opposed, same sign. Motion carries.
Thank you for your time.
Thank you.
Thank you.
On to the review rate of return assumption. I think a year ago now, last May, we went from 7.25 down to 7. Is that correct?
Yes.
Go ahead. Do you have any advice or guidance for us?
Again, markets as crazy as they've been, I think we'll take a hard look at where the capital market assumptions are, expectations for that. and be back to you next quarter to see if there's any
Okay,
need to make any further recommendations.
okay, sounds good.
I'll make one other comment on that issue that with the sharp rise in inflation that we've had this year and the sharp rise in interest rates, what we're seeing is that capital market assumptions at this point are quite a bit higher than they were a year ago and 2 years ago and 3 years ago. So, and you just made that change, a 25 basis point change last year. I don't know what Hooker and Holcomb is thinking regarding that assumption, but 7%. I agree with Ken that it makes sense to have a further discussion at it and look at it more deeply at the next meeting.
Sounds good to me. The board okay with that?
Yep, Jason, I am.
Okay, thank you. Do we have any other business? Okay, if not, the next meeting is Thursday, November 10th. And I will entertain a motion to adjourn.
I just have a question. Do we know if it's going to be 2 o'clock again or 3 o'clock?
I think 3 o'clock's fine. And is that okay with people? Ken or Pat or anything? Do you see any need to meet earlier?
No, 3 o'clock's been great for us. So, yeah.
Okay,
That's good.
I move we adjourn.
Second,
second. Okay, any discussion? All in favor, say aye.
Aye.
Opposed, same sign. Okay, thank you, everyone.
Thanks
Have a good
you all.
day.
Summer.
Take care.
Have a great rest of
Thank
the
you.
summer. Bye
Take
now.
care. Bye-bye.
Bye.